Everyone. Thank you for joining us. Uh, Today, we're going to talk a little bit about endowments at the foundation here and hope that well, I'm hoping, and probably it's accurate to say that each one of you is a fund holder or works for a fund holder here at the foundation. Uh, just briefly, these are our mission and vision statements from the foundation. Uh, if you're like me, you may wonder what we really do, because those are always things that are uh, summaries of what we do, but we'll get into that. This is what we think we do. We've been celebrating 30 years. We were formed in 1995, and there are several things that we do. We make giving easy. Alaskans help us make that meaningful across many different platforms. We have over 2,500 active funds here at the foundation, and it's very important to us to have those here. We have over $270 million in charitable assets. Over half of those are endowed. So you're part of that community and part of our community, which will go on forever. We also inspire and advance philanthropy statewide, and we're trying to strengthen our communities for needed services going forward. We connect resources locally with donors and community priorities. We listen, and we have 11 affiliates around the state that help us do that, soon to be 12. And also, we provide good stewardship over the investments and operations within the foundation. There's a focus on permanence here, as I said, and our tagline, for Alaska Forever. The key word there is forever, and that's due to the power of these endowments, which we'll see here in a little bit. Here's the agenda for this afternoon. Endowments are here for the long haul. And we'll talk a little bit about what an endowment really is. Many of you may already know that. Investments, why and how. The distributions, the spending policy, and how money is distributed to the beneficiaries of the funds. What happens when investments change and fluctuate, because they always do. And then a summary. An endowment, what is it? It's building a permanent asset base that's designed to generate an annual income for the benefit of the beneficiaries of the fund, or funds, plural. It accomplishes this by investing the funds over time and controlling the spending or the distributions from the fund to allow it to grow, and inflation proof over time. We want the amount of money that has been contributed over the life of the fund to match what was originally donated. And over time, obviously, that has to grow to keep pace with inflation. What's the Alaska Community Foundation's role? Once the nonprofit transfers assets to ACF, and I'm referring to an agency fund, some of you may have different types of funds that also support an agency, such as a designated fund. But once the transfer of assets occurs, the Community Foundation becomes a legal owner of those assets. We hold those assets, in the case of an endowment, in perpetuity, and we steward them according to our investment and spending policies. And so you can see that on this slide, we talk a little bit about that legal ownership, the investment management, distribution of annual payouts. We also do fun things like accounting, reporting, compliance, and tax returns. And we also support donors who might want to give to your endowment, and also complex transactions that might be helpful to your cause. Hang on just a minute. I'm trying to figure out why the slide won't advance here. There we go. Endowments are here for the long haul. It's a perpetual pool of assets. Perpetuity is a fancy word, but it means forever. And many of us have parents, grandparents, and things like that might get us to 50 or 75 years, or even maybe 100. But when you start talking about forever, you are it's a very different concept, and one that we're very serious about when you talk about an endowment. It's to support a specific purpose, cause, or nonprofit forever. They're structured, as I said earlier, to worry about the inflationary effects that happen to the lifetime contributions, or as we call it, principal value across time, so that a distribution today from that fund is worth the same thing 100 years from now. And I'll give you some examples of that from an actual fund here somewhere along in this presentation. Um, as you can see, with the power of an endowment being built. They're designed to make an unrestricted revenue stream to the recipient, and that there's no immediate expectation of results or even a time horizon, since you're dealing with perpetuity. They're invested because we want those things to grow, and they're pooled with all the other funds that we have here that are in that investment pool, which is our largest investment pool that I'll be talking about primarily today. And it's invested in a diversified portfolio that utilizes both active managers and passive index funds to add value. It's conservatively invested, and it's done according to our investment policy statement, or IPS, which is governed by our investment committee, and is available for you to look at any time on our website. That investment policy statement goes through a number of things, which we'll talk about in the next slide. The investment policy statement, and I'm summarizing some 17 or 18 or maybe even longer than that pages. It contains a number of items, but one of the items that's very important is a long-term growth of capital. We want to emphasize that growth, but we want to also avoid excessive risk. We'll talk a little bit about that. And we want to preserve that purchasing power that we talked about, or inflation proofing. So that investment policy statement talks about some of these terms. Perpetuity, it's conservative, it utilizes diversification, which we'll get into a little bit, specific asset classes and investments, and avoiding excessive risk. It also defines the objectives and investment goals, liquidity and marketability of certain assets, and certain allowed or even prohibited types of assets to hold. So it contains a fair amount of information. That long-term pool looks something like this. And when we talk about diversification, this is what we mean. About 53.5% of that pool is in global equities or stocks, both public and private investments. Publicly traded stocks and bonds are in the fixed income category below, but they are both public in nature. There are also some private investments we hold in both the equity and fixed income markets. You can see some definitions of what's in those. I won't go into those too much. By the way, this PowerPoint, it will be available to you in a PDF format later on. So if you really like a slide or really want to talk about something more, you can grab a hold of it and read it when you have more time. Real assets, those are things you can touch. Energy, timber, commodities, real estate, things like that. We hold about 9% of that portfolio in that. Diversifying strategies are things that are categories, private investments typically, where we're trying to make sure that we're investing in something that does not move in tandem with the markets, the public markets. So we're looking for things that will diversify away from that. As an example, one of those we hold is a refrigeration entity that has come up with a very unique way of storing frozen materials in ginormous warehouses across the globe, and is managing to save a great deal of money with respect to the energy required. I won't go into the details, but it's an interesting investment, but that would be one that is in that category. And then we keep a little cash around to be able to handle liquidity when you folks decide that you want to take some money out of your fund, or to pay certain expenses and so on. This is what our long-term pool looks like in terms of its investment returns. This is through September of 2025. We're still working on December's results, but you can see what the portfolio, that's the top row there, has done over a period of time. We hope that we can attain at least a 7% return every year. And you can see we've outperformed that. There are two indices or benchmarks that we compare ourselves to. One is one is a index that just is basically a 60-40 stock split with a 10% treasury and tips index in it. The other one is a much more complex index, which matches what our investment policy statements portfolio looks like. And you can see over the 10-year period that we're actually outperforming both of those measures that we hold ourselves to. So that's good news. So we've talked a little bit about investing those funds. That means your endowment is growing. How and when do you get money out of your endowment or distribution? So they're subject to a prudent strategy that's based on a number of factors, including a law called the MIPFA, the Uniform Prudent Management of Institutional Funds Act. Such a mouthful that nobody wants to say it. But that those are subject to this distribution policy, or we call it a spending policy. They're structured to capitalize on good years, but protecting that principal or the value of the contributions made over the life of the fund in low or negative return markets. Our investment committee and the board of directors for ACF sets that distribution rate annually in November. That it considers a number of factors, including the return that we've had in the portfolio over time, inflationary pressures, administrative expenses, the general economic conditions, and also what's going on in the nonprofit environment in Alaska. Our board makes that decision in November and sets the rate for the upcoming year. And you can see that rate historically. Here is the list from 2008 onwards. And you can see that it generally moves between 4 and 5%, but usually is in the lower tier of 4%. 4.25% was the last 2 years in a row. And you can see that it dips down every once in a while when returns challenge that and make it difficult to protect those endowments. Now we're going to get into the actual calculation that goes on. And this might get a little far down the weeds, and I apologize for that in advance, but this is how we actually do the calculation. So the first thing we do is come up with a average of the last 16 quarters of your fund. And this is an example calculation, but we do that as of September 30th of every year. You can see this particular fund has bounced around a bit. It has gotten some serious donations. You can see it started with 25,000, and at the end of Q3 2025, it was at 157,000. So it's obviously gotten some activity going in it. The average for that fund over those 16 quarters is $96,000. You can see that that's not the same as its current balance, which was 157,000 at that point in time. We take that percentage that the board set for us, in this case, the 4.25%. We multiply that by that 16-quarter average of 96,000, and you get this particular fund would then get a spendable distribution of $4,080 for the upcoming year. There's one final test that we do, which is to make sure that we're not going to pull the fund underwater. And by that, I mean pull the fund's balance down below the principal amount or the lifetime contributions within the fund. So we do this test. We look at the balance, in this case, 157,000. That particular fund had $128,000 worth of principal or contributions over this lifetime. And it also happened to have some unspent spendable from previous years of $5,950. So we take that $157,000 balance, we subtract off the original principal, we get $29,000, which is greater than the sum of the unspent principal and the spendable for 2026. And therefore, everything in this fund is fine, and it'll get its full distribution of $4,080 for 2026. We do that with every fund within our endowment structure to make sure that we're protecting that balance, that we're inflation proofing over time, because the spendable percentage is less than what our uh, investment earnings are likely to grow at, which we believe is a 7% target. So you can see that over time that helps with inflation proofing the original balance. So like in that fund example we just saw, your endowment fund balance is greater than that principal. In that case, it was 157,000 versus 128,000. Well, we've been asked before, can I have that? Can I utilize that money? Well, part of our responsibility, as we've talked about, is inflation proofing the fund. And I'm going to give you some factors here, an example from an actual endowment here at the foundation. This particular example fund was primarily funded, or contributions came in the years 2010 and 2011, primarily in 2010. The inflationary factor between 2010 and through 2025 was 48.57%, meaning a dollar in 2010 requires $1.49 today just to be equal. And it wasn't a crazy inflationary environment during that time frame. The average consumer price index rose by only 2.67% during that period. So not a crazy inflationary environment, not one that was much different than the Fed's goal of about 2%. And in between 2 and 3 is what they consider to be acceptable. But if you take their $95,000 corpus that they happen to have in that fund, multiply it by that actual factor of 1.4857, you get the fund ought to have $141,141 in it. Remember, that particular fund had 157,000, so it was fine. But just to make sure that fund holds its own over time, you can see that you do have to build up something, we call it headroom, between the balance and what was originally funded throughout the years of the life of the fund. So enough of the actual calculations. Let's talk a little more about theory here. We remember that the endowment's aim is perpetual support, and we're going to face risks in market changes and market fluctuations that will happen all the time. Sometimes they go up, sometimes they go down, sometimes they do both. And so we're involved, just as every investment is, including probably your 401k, in all kinds of different investments. We use the diversified long-term investment strategy, which we'll talk about. We already talked a little bit about, and we'll talk a little bit about more. And we make sure that we're spending prudently out of the funds so we don't draw them underwater. But significant downturns can often force cuts or some kind of policy adjustment. So let's talk a little bit about some of the public markets and their behavior over time. Remember, we're talking in endowments of a very long-term perspective. So I'll give you some factoids here. The S&P 500 from 1926 to 2024, it returned an average annual rate of 10.2%. So here's some trivia. Over that same period, 1926 to 24, how often did the S&P 500 return actually fall between 8 and 12%? Basically, just around that 10.2% annual return, right? By a couple of points in any single year. So we got a very long period of time, almost 100 years. And how often did it come close to that 10%? Well, here's your answer. Only 8 of those years. Out of the 98 years there, only 8 did it actually fall in that window between 8 and 12%, which tells you that there's a lot of volatility in that market. That we're using the measure of the S&P 500 index, and that is 500 stocks within the larger U.S. public equities market. If you like graphs, here's a better way to look at it. The red lines are negative, the green lines are positive over roughly that same period. Not quite, this graph doesn't go quite to the same extent, but you can see that it's up and down all over the place. You can also see that same graph this way. And this one I think is a little bit more useful. If you look here in the center of that particular graph, right here, the gray line, that's where the zero positive returns start, 0 to 10%. And the green lines above that are above the 10% mark. The ones on the other side of the gray column here in the center are negative. And if you count them up, what you'll see is that 73% of the time, equity returns were positive, and only 27% of the time were they negative. It clearly tells you a little bit something about the markets. It basically says that 3 out of 4 years, you have the odds are that you will have a positive return. It doesn't talk about quantity as much, but it is positive. And so over time, which, and of course, an endowment's all about, you are likely to succeed. So what are our takeaways from that? Well, time is your friend. The longer that time horizon, the more likely you get into the bucket of positive results, right? You got a pretty good odds, 73-27. I don't think much in Las Vegas gives you that same opportunity. It's also tough to predict which asset class or type of asset will generate the returns that you're looking for. So that's why you need to utilize some diversification in your portfolio, which we'll talk about here in a second, to manage that unpredictability within asset classes. And so is there a way to actually manage that? And the answer is yes. It's something called modern portfolio theory, which is a formalization of asset diversification. It's the idea of owning different classes of assets is less risky than only one. The old saying of putting all your eggs in one basket is also the same concept. You don't do that when you carry a bunch of eggs. You put them in a couple of different baskets. That way, if you trip and fall, you might only break one of them, and you wouldn't break them all. The same idea applies here. And that's what modern portfolio theory is really all about. But basically, it comes down to a diversified one that has multiple eggs, has a better chance of weathering those economic cycles that are likely to go up and down. What is diversification? Well, it's complementary assets, such as stocks and bonds, that don't usually perform in the same manner. I.e., a stock might go up, a bond might go down. That's generally how they work, although not always. And the concept is that if one part of the portfolio is declining, perhaps that can be made up or offset at least by another part that's rising. They can also be built around geographic areas, or as I described earlier, some non-correlated investments like private equity, private debt, and the example of the refrigeration company I talked about, alternative investments. I won't go into crazy theory about diversification, but this graph tells you a little bit of something about diversifying portfolios. There are 3 lines on this graph. The red one is the S&P 500 and long-term government bonds. That's a portfolio made up of those 2 elements. The blue line takes that and adds real estate to it. And the green line takes all the blue line and adds U.S. small value stocks into it. And you can see that your return climbs going up. That's in the reward left axis. But your risk may also go up or may stay the same. So the key takeaway in this graph, though, is that you can look at it 2 ways. You can look at this, that you can just increase return by doing that. And that would be this blue line that runs straight up from about the 13.5% mark. And your return is the same in all 3 cases. Well, I'm sorry, the return is different in all 3 cases based on what line you're looking at. Conversely, though, you can also look at decreasing your risk. You want to move down this x-axis from 13.5% to, let's say, 11%. If you're happy with, say, a 10.5% return, for instance, you could reduce your risk substantially with the green line than you could with the red one. The outcome of this graph basically is that if you're happy with the return you want, you can set your level of risk. And that's what we do when we look at the portfolio we manage. So let's talk about takeaways from all of that. Time's our friend. The longer that time horizon, the better our positive results are likely to be. And that is true for an endowment. You always want to think of long term. What do I mean by long term? At least 20 years, not five quarters, not 2 years, 20 years at the minimum. And really, we ought to be thinking about doing this for a lot longer than that, because that's what the purpose of an endowment is. Equities are still part of the overall strategy. That's stocks. They're more volatile, but with time, I showed you those returns. You give you roughly a 3 out of 4 chance of success. And adding additional asset classes or diversifying your portfolio makes a difference, and it can reduce the risk that you are experiencing in the portfolio. So endowments have to survive these market volatility times. You can watch what has happened in the last 3 years and be very impressed. The S&P 500 since December 31st, 2022 has returned 86%. I'm going to say that again, 86%. And 2 out of 3 years have exceeded 20% in returns. So it's pretty amazing what has happened in the last 3 years, but that doesn't mean that it's forever going to go up, and certainly not at that rate. I wish it was. But what do you do to survive it? Well, you stay invested. You keep to your policy and to your procedures and to your portfolio design, because you want to resist the short-term bias in trying to chase what we call the dragon's tail when you want to get into the latest and greatest thing. Obviously, we're not investing in crypto, or we're not investing in things that are latest and greatest and have shown amazing returns. We may get to some of those through the nature of the wider investments we hold, but we're not going to go chasing that short-term bias or short-term reward that might be there and then might fall apart tomorrow. We manage that risk through diversification. And you remember why you're invested. You're here as an endowment for the long term and the long haul. Here's something that might make you feel a little bit better. This is the history of the S&P 500 index fund, again, from roughly the same period we talked about before, which was 1926 through the COVID timeframes. The yellow lines are when there were significant recessionary periods. But what's really telling out of all of that is that it goes up around some of the biggest things that have happened: World War II, the Great Depression, Vietnam, the oil crisis, the Gulf Wars, and all those that climb up this ladder. So remember that you're in it for the long haul. The likelihood is things will go your way. An endowment, remember, is a protected permanent base of assets here. And we accomplish that by conservatively investing in it and controlling the spending through the spending policies, and you allow that to grow over time. They exist to create that perpetual unrestricted revenue stream for the beneficiaries of the fund. And we're your partner here in prudently investing that, spending it, and for Alaska Forever. We're here for you. And I'll stop there. And I don't know if we got some questions involved or not.
Thank you so much, Kevin. Yes, we had two questions from Heather, one that we did answer in the chat, and another I was just getting ready to respond to. And Heather's question is, what does it cost ACF to act as a holding company for specific, usually current needs? For example, with Voices Across Alaska, I'll also add in maybe Western Alaska Disaster Relief Fund because they were handled a bit differently. And then does ACF charge a fee for service? So I will pass that to you, Kevin, for answering.
So there's a mixture of answers to that question because you referenced several different types of funds. So for disaster recovery funds, such as the Western Alaska Disaster Recovery and Voices Across Alaska, we typically will not charge much in the way of a fund or a fee or none at all, depending on the source of those funds. So typically, with regular donations coming in from the public, we won't charge any fee at all for a disaster recovery fund. We may have those covered by other entities, whether they're other foundations that choose to join in with us, or other means. We might cover it from some of our own unrestricted funds, but we typically will not charge those funds a fee, or if we do, it's a very reduced fee. In terms of fees for regular funds or for other funds here, yes, we have administrative fees that we charge, and they range from 1% to 2.5%, depending on the type of fund, whether it's endowed or not, and whether there are extra services that are involved. As an example, a scholarship fund carries additional services that an agency fund does not. And the difference there is that we are taking applications. I believe last year we had over 1,200 students apply for over 65 scholarship funds that we have here. And over 3,000 applications, because we have a universal application which allows a student to apply for more than one of those funds at the same time. We're using only one application, but they might have, in the case of that math, it's because they were able to maybe apply for three of those. So obviously that carries a greater burden in terms of administrative support here at ACF than an occasional distribution from an agency fund. So their charges for an agency fund are lower, obviously. We also have investment fees, which are part of the investment returns that that portfolio generates. Those are everything from some bank transactions to we have an investment advisor that works very closely with our investment committee here to make sure that that portfolio is invested strategically and is adhering to our investment policy statement, which we've referenced several times. And those fees are spread across all of the funds that are in that pool relative to their balance within the pool. And they range to about 15 basis points, which is 0.15%. So not very much, but those are part of your fees. Those are called out separately on your fund statement. You can see those as investment and custodial fees. And the administration fees that we charge are labeled, I think it's foundation administration fees on your fund statement as well.
Thank you, Kevin. I have another question in the chat. Vaughn asks, if an organization dissolves, can it transfer the balance of its account in ACF to another entity?
The answer is yes. And there are two mechanisms for that to occur. If the entity is still around and knows it's coming to the end of its lifespan for whatever reason, it can suggest using whatever mechanisms it has set up to ACF that we distribute the money either to a grantee that it favors or to a fund holder here that may have a similar set of services or maybe slightly different regional aspect to it. The other way, or the other mechanism that is used primarily in, I'm going to call it difficult circumstances, is our board holds something they call variance power over every fund here. That variance power allows our board to redirect those funds to the best use that is close to the original purpose of the fund as possible. Some examples over the generations, not here necessarily, but in foundations are, let's say, something was created to eliminate polio. Well, that may have largely been eliminated globally, and so the purpose may want to move to some other purpose, or some portion of those funds might want to. And so we could work either way to make sure that those funds are redirected. And with an endowment, that has to be possible because we don't know what the future holds. 100 years from now, maybe kidney disease may be eradicated, or something else that we're dealing with today may not be present. So it has to have that ability to change with the times.
Thank you, Kevin. I don't see any more questions in the chat, but I think we can take this opportunity where if you do have a particular question, feel free to come off mute and you can ask that. And we'll stick around for a few more questions.
I arrived a little late. You were talking about the endowment portion or the spendable portion, the non-spendable portion. Is it just highly discouraged to spend in the rest of it, or is it just absolutely impossible to get at that?
It's generally not allowed. And the reason I say generally is because there are some exceptions. You can ask our board for variance power to vary from that. However, we don't grant that very easily. In other words, if you're about to go out of business, that's something we can talk about. On the other hand, endowments are built for the long haul, and accessing the amount above that spendable creates a situation where you're going to start pulling down the balance of the fund below the original contributions that have been made to that fund, and that puts the fund underwater. Yeah.
Right. Yeah, I understand. It was just, I'm the PTA president in Seward, and there was a comment at our last meeting. Oh, we can get at the spendable amount. We just have to do some more work. And I wanted to clarify that no, we really can't.
Right. Yeah, it discourages the reason to have an endowment in the first place. You're really
Right.
set up to be there in perpetuity.
I agreed. I just wanted to clarify that that's really not an option.
Right.
Thank you.
Hey, I have a question. If an individual writes out a check to you and indicates that it's to be put in our fund, what happens with that money?
So that's a very good question, and I won't go crazy with the answer because unfortunately, the Financial Accounting Standards Board, or FASB as it's more normally known, which controls generally accepted accounting principles or GAAP in America, has a ruling on this. What it says, and I'll be fairly brief, it says that if the agency itself, in other words, your agency writes us the check and puts that money in an endowment for the benefit of your agency, we have to keep that money separate from a third party donor who comes in and says, I'd like to donate to your agency fund, but I'm writing a check personally, and that has to be kept separate. And the accounting treatment of those is both different on our books as well as your agency's books. And I won't go deeper than that. I'm happy to send you money. I had a question from a longtime fund holder of that very question on their 990 this week, as a matter of fact. So it's not an unusual question, but it gets down into the weeds of accounting, and I'm happy to go into it, but I don't want people to go cross-eyed here. Did that answer your question or no?
Well, I have a lot more questions about it, so I'll talk to someone else later.
Well, that's fine. And you're welcome to stay on after everybody else drops off, and I can work through that with you, or we can. My finance group is on, at least several of them are. I can see some of their faces, so we're happy to talk more about it.
Okay.
I do have one more question in the chat I just want to raise. Allegra asks, if the spendable distribution is left unspent, does it stay as part of the total endowment fund, and is it invested as part of that? And then she goes on to say, if the spendable distribution is returned to principal, what is the effect on the future spendable fund calculation? Great
question. So the normal process is that you're allowed to accumulate your spendable and not take it out. It stays in, I'm going to call it an available balance for you. You might have 3 years worth, and then you decide you need all of it, or you need maybe half of it or something, and that's fine. But it starts to accumulate over time. It is part of your regular endowment. It is part of the same monies that are invested, just the same as the part that isn't available to you, i.e. the principal. And the reason for that is we have so many funds and such a big quantity, we can deal with the liquidity issues where you raise your hand and say, I'd like some of that money. because we have enough money moving around all the time. So that money is still invested for you. And then if you exercise the option to return it to principal, which you can do, then it becomes part of, just like a contribution from someone else, or from you in this case, the agency, and it becomes part of that principal test. So you've moved that mark up, right, from where it used to be to a new mark for the principal hurdle. And that's okay if that's what your board wants to do. You can protect it that way. But it also means that you then might have to wait more time to build up the necessary amount to be able to produce another spendable. So I'm not saying it's a 16 quarter time frame, but what could happen is market fluctuations might make that challenging. It might not, but that's okay. You can protect it that way. You have that choice as a fund holder. Most people don't do that. I think it's happened once or twice, and I've been here for about 10 years. But it is an element that you can do if you wish to protect that money. Did that answer that?
Yes, it did.
You have a question. Are all third-party contributions pooled, or is each third-party contribution set at a separate account?
I probably didn't go far enough down that tree. Yes, they're kept in a separate fund. So an agency will have two funds here. One's called an asset fund, and the other one's called a liability fund, and that has to do with that crazy accounting treatment that I discussed. But you end up with two funds. Those monies are stored separately, but a spendable calculation is done on each of the funds respectively, and you can draw from that one or the other or both of them at whatever time a spendable is generated from those. Because they occur at different times, potentially, that may not be available right away to you, right? If I make a donation to your fund today, it has to go through 16 quarters for the math to work out for you to get a 4.25% spendable of the amount I gave today. So over time, that may differ from the amount of money your agency initially put in to fund the fund. And so they're basically operating as two separate funds, but you are eligible to claim both of those. Does that answer that?
It does. Thank you.
I have a question. Is Community Foundation audited every single year? And if so, is the audit result along with all the 990s available on the website or publicly generally?
Yes, to both of those questions. We are audited every year. Our current auditor is BDO. There is an audited financial statement on the website. The last one available is 2024. And typically those would come out around September of every year. We usually go through our audit in the April to May timeframe, and then there's assembling the financial statements that goes along with that. Our Form 990 is also available on the website. The latest one for that is also 2024. And they're on, I want to say it's the finance page, but someone can correct me if I'm not figuring out the right place.
I'll make sure to include a link to our current audited financials in 990.
Thank you, Kevin. Thank you, Celeste.
Thank you, Heather. We have a couple more questions in the chat I'll read out. So Kevin asks, what is the basic procedure for accessing spendable funds and the approximate timeline that it would be available?
Great question again. You guys have some great ones. So the easiest way is to access your fund through our portal. We have a fund portal. As fund advisors, you have access to that over the internet. And you have an email login along with a password. You can request a grant from that, and it's very easy to do. We do that for all our fund holders here, including donor advised funds and others. But your endowment, you can do that. When you log in, you'll see what your balance is and also what your spendable amount is, or spendable balance. And you can request that full spendable balance, or you can request some subset of it. If you're not set up to do that, I encourage you to do that, and because I believe it's the most efficient way for that to enter our system. The other way you can do it is to email us, and you can do that to the grants@alaskacf.org email address and request the grant. They will do their necessary homework to make sure that you're an authorized individual requesting that amount. We'll enter it by hand into our system. The timing of all of those is once that grant is approved in our system, we typically run checks once a week. That's done on Thursdays typically. So basically, it generally takes about 14 days or so to get to you, assuming the U.S. mail is being relatively efficient. Um, and so not too long of a time frame from when you request a grant to when you actually receive it.
One more question in the chat. Greg asks, does a donor designated fund have to wait the 16 quarters to begin earning interest?
No, you earn interest immediately. So every month we push out the investment results to your fund, and you can see what your balance change if you were to log in and monitor it very closely. So you'll start earning investments. We make every fund wait a minimum of 5 quarters because we want to make sure that the investment returns have started to make it possible to have an available distribution or a spendable amount calculated. The average calculation that goes on, though, will mean that it will look at that 16 quarters. If you have, let's say, 7 quarters in it, it'll divide by 7. If you have 8 quarters, it'll divide by 8. So the average that is going on up through the 16 is somewhat less than that. But the reason we do that is to smooth out some of that crazy market fluctuation that you see. We want that average to represent a reasonable balance to calculate the spendable percentage on, because one day it'll be here, the next day it'll be there, and so on and so forth. And over time, that tends to smooth out. And that's why we use that 16 quarter average.
And the only other note I would add is that with a donor designated fund, which is a type of fund, and we have many types of funds, including agency funds, donor advised, designated, scholarship, those can be either endowed or non-endowed. That's just the type of permanency attached to that type of fund.
And oftentimes a donor designated fund means the asset fund or a contribution was made by a third party for the benefit of either your endowment or non-endowed fund, the agency typically.
We don't have any more questions in the chat. Opening it up for any more questions on the Zoom call.
Thank you.
And you bet. Gail, if you'd like to stay on, I'm happy to try to answer that in more detail if you'd like.
Yes, please.
Okay. Well, thank you everyone for attending. We really appreciate you spending your afternoon with us into your evening. I'm going to stop the recording now, and we will be sending the slides, the recording, as well as links to our admin fees, our audited financials, and other relevant information in an email that you'll receive next week. If you do have specific questions about your fund, feel free to reach out to me. We'll try to answer that question or get you in touch with a staff member who can answer that. Otherwise, I hope you have a really great rest of your evening and stay safe and warm out there.
Thank you. Enjoyed it.